What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked number one on Wall Street in the All-America Institutional Investor Research Survey.
Hello, Emily. Good to see you.
Hey, Steven. It's great to be back.
Interested to hear your thoughts on what was another interesting week in markets.
Yeah, so it sure was an interesting one, particularly earlier in this week. It was a bit of a head scratcher. There were a lot of questions we were getting from clients on the fact that we had rates that were up, oil was up, and yet the S&P 500 was making all-time highs despite those things happening. And it wasn't just the S&P 500. It was the 400 mid caps. It was the 600 small caps. It was the Russell 2000, even micro cap index was making all-time highs. So it was a broad participation across the market. That was a meaningful signal. It wasn't just a handful of mega cap names that were carrying the market.
It's pretty amazing. I saw that chart you had done of the year-to-date returns, and pretty impressive. We are off to one heck of a start when you look at the overall return numbers for all the size and style boxes. I think all but healthcare and financial sectors wise are up on the year.
Yeah.
But if you follow the market every single day, there's just so much to distract you from what overall has been a pretty good year, especially for the broader market.
I think that's absolutely correct. I would say the same. And I think if you look, like you said, if you look at sectors, you've got every sector except for two are up meaningfully. If you look across size and style boxes, about half of the size and style boxes are up double digits. The worst performing size and style box at this point is large value, which is up 5 and change, but everything else is up, some of them are considerably more than that. And certainly to your point, if you look at what's going on in the headlines and talk to investors, there's a lot of concern still out there because there's so much uncertainty. And that uncertainty at this point is really mostly coming from what's going on with oil and the Iran conflict. And so when we take a step back and we look at what's really driven all of these different markets to all-time highs, it's really boiled down to the earnings story. And we're just coming out of Q1 earnings reporting season. This was the last big week for the S&P 500 of reports. And we've got just about everybody has reported at this point. And it was really a stunning earnings season when you look at how the numbers shook out. Q1 saw at this point an 84% beat rate. So that means 84% of stocks that reported beat earnings estimates. And where consensus earnings are now from the sell side, we are now at a 25% NTM EPS growth year over year. And that, I know you study earnings, and you know just about everything there is to know about earnings, but that is a rarity to see that kind of earnings growth rate historically.
Earnings have been incredibly strong and incredibly broad. We're so used to large cap growth and tech and being like, well, that's the only reason. And you still hear it this year. People talk about how, oh, large cap tech and large cap growth, they're continuing to power. They're a huge part of the index, so they definitely make up a large contribution, but the marginal contribution to earnings is coming elsewhere.
Yeah, I think it's a very important point. I mean, to your point, we're still hearing that this week, people saying it's all AI and tech that's driving the strength in earnings. And well, that's certainly, to your point, is a big part of it. It has been way more broad than that. And this is the first time in years that we're seeing this kind of broad-based earnings improvement. And I think it's important to note all those other concerns that people have about oil and rates and conflict abroad, those concerns are showing up in multiples. We've seen over the last couple of days, we've seen some improvement in PEs, but we are still very much down year to date in terms of PEs. So these rises to all-time highs across all these different markets, they're happening really in spite of, not because of PEs. And I think that's a really important nuance because the story this year has been all about earnings, and that's what's been lifting markets. And we like to do a breakdown where we look at, okay, if we look at year-to-date returns for the S&P 500, how much of those returns are coming from earnings growth versus PE expansion or contraction? And if we look year-to-date, earnings have actually contributed more than 12% to the rise in the S&P 500. Now, the S&P 500 is not up 12% because we've had PE contraction, so that has taken away a bit. But it really has been a story of earnings growth more than offsetting the PE contraction. And I think when people talk about where we can go from here, our expectation is that we're going to continue to be in a positive backdrop for earnings. The PE story is quite a bit more unclear. And that is really going to boil down to what happens to oil rates and the conflict. And as we've seen, the headlines change day by day, minute by minute. And there's a lot more uncertainty there about what's going to happen to PEs going forward.
So the market would be up even more if it wasn't for the weakness we've seen in multiples, because earnings have been so unbelievably strong.
Yes, that is absolutely correct. PEs have taken away more than 4% from the S&P 500 return this year, given where we are today.
Wow, that's pretty incredible. It's the obvious question is, put on your macro hat for a second. Why are earnings getting better? What is driving this strength after 4 years of bifurcated earnings, the kind of the buzzword where it was just AI and tech? What's changed?
My macro hat is always on, Stephen. I sleep with my macro hat on, but I will say that we are now finally seeing the data improve, the cyclical data in the economy. And we on the strategy team spend a lot of time focusing on PMIs, manufacturing PMIs in particular, because they do tend to correlate best with earnings. They are a cyclical indicator of the economy. And we are finally now seeing PMIs rise significantly. PMIs for the month of April, which have been released over the last week, are at new highs that we haven't seen in several years. And we had been in a period after COVID and from 2022, 23, 24 into 2025, where those PMIs really went nowhere. And we are now finally seeing a lot of them break out to the upside. So the global PMI made new highs, new cycle highs this month. The developed market PMI made new cycle highs. The emerging market PMI picked up close to the highs. So we are seeing broad improvement in the cyclical data around the world. And that tends to correlate extremely well with earnings estimates. And so we've seen, as that data has improved, we've also seen the earnings expectations improve, which is what you would typically see and what we would expect to see. And so we are seeing the case where we had stimulus in the system from the Fed cutting and from some relief that we had seen from rates and oil coming into this year. And the lagged effects of those have boosted the data as you would expect. Now, of course, we are seeing higher rates and higher oil today, but there is a lag time in terms of how long that takes to flow through and ultimately become a headwind to things like manufacturing PMIs. So that's a story for down the road. But for right now, we are still in a positive trend where we're expecting to see earnings expectations continue to improve from here in the months ahead.
So it sounds like all's good on the earnings front outlook. What is your outlook for multiples?
So that's a bigger question here. And the multiples have continued to move pretty tightly with trends in oil and rates. Obviously, earlier this week, we saw a little bit of a disconnect there where the market moved higher, even with rates and oil higher, but that was an anomaly. We are now moving past Q1 earnings season. So I think that the focus is going to be even more intensely on rates and oil, back to that regime. And so it's going to matter a lot where those things are heading. And the headlines are changing so fast. So we don't have any real conviction on what is going to happen as far as when this conflict will be resolved and how high oil can get. Certainly, if we go higher from here on oil and rates, that would be a headwind to multiples. If we get relief, that would be a positive. We like to say that we're at the threshold here where we are still uncomfortably high on both of those theories. So we like to think about $100 on oil as being a threshold and 4.25 on rates as being a threshold, above which, as we move farther and farther from those levels, things could get a little bit more concerning from a PE standpoint. So again, now that we're moving past all the positive data and news from the earnings releases, investors are going to be even more focused again on those rate and oil series and what's going on abroad.
So we've talked a lot about the overall market and overall indices and that kind of decomposition of earnings and multiples. Underneath the surface, there's always trends. Like, what are people buying? What are the leadership trends when you dig down into stock selection that you're seeing?
I would say there's two really clear themes that are at play so far this year. And that is that price momentum is doing exceptionally well and earnings momentum is also doing extremely well. Those, when we look across all of the factors that we track, and we track about 120 different factors, those are the top two performing factors year to date. And it sounds like they're both momentum factors, so you might think that they're being driven by the same criteria, but they're actually fairly different factors. I would say price momentum, which again is by far the best performing factor this year, that's a factor that tends to do well when there's high uncertainty. When people aren't sure what's going to happen, they tend to lean into whatever's been working best. And that's certainly something that we've been seeing this year with high oil, all the uncertainty abroad. Alternatively, earnings momentum has been doing really well this year. When we think about earnings momentum as stocks that are seeing the most positive upside revisions from the sell side. So basically, those are the stories where the sell side thinks that the stories are looking better and better. And
On the
that,
earnings.
on the earnings standpoint. And that factor is doing really well this year. Part of this reason, a big part of the reason for that is that earnings, like I said earlier, is really driving returns for the market. So if you're in a backdrop where earnings are strong and PEs are flat to down, earnings are really the main story. And so in that type of backdrop like we've been in, investors are reaching for the stocks that are seeing the best earnings stories. And so that's pushing earnings momentum to be one of the top performing factors as well. Now, what's interesting, I think, about the dynamic between these two factors is that their behavior over time is very different. So price momentum tends to be more of a boom bust factor. It generally is either at the very top or the very bottom of the factor table in terms of performance. So it's either a very good year for price momentum, it's a very bad year. Earnings momentum tends to be a more durable, it's more of an investment type of a strategy where it tends to outperform more often than not. And that's because it's rooted in that strong earnings fundamentals. So if we were to be in a backdrop here where there is a clear resolution to the Iran conflict and the price of oil and rates drop significantly, price momentum would be more at risk, whereas earnings momentum should hold up in a much better way in that type of backdrop. So we tend to prefer earnings momentum as a factor over price momentum most of the time.
So it sounds like leadership is really a reflection of what's going on in the overall market. If you're focused on multiples and all the news flow and the uncertainty that is swirling around geopolitical events, you're leaning into price momentum factors. What has worked should continue to work. Then you have the other side of the spectrum, the earnings story, which is the overall driver. And as that continues to be strong and broader, and as those expectations continue to get ramped up, those stocks are doing really well.
And I would say that earnings momentum factor, just to further the point, it's been outperforming in just about every sector. So it's certainly not just a tech story. This really goes beyond tech to in every sector, the stocks that have the strongest earnings stories are outperforming, and multiples compression that we've seen year to date has occurred in most sectors.
Which goes back to the why the smaller cap, mid cap is all outperforming larger cap.
Yes.
That's where you're seeing a lot of the earnings growth. So the big takeaway is keep an eye on earnings. They continue to be strong, expect them to be strong. Hopefully we get a resolution in rates and oil, which should put some stability behind the multiple number. And from a positioning standpoint, maybe start fading some of that price momentum for more earnings momentum.
Yes, I think you summed that up very nicely.
I love it. Thank you so much, Emily.
Thank you.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.